What's up, gold miners? Today we welcome Michael Houlihan to the program. No matter where you live in the country, chances are you've seen Michael's product before. Michael is the co-founder of Barefoot Wine, the nationally recognized wine brand that has achieved #1 status consistently over the past several decades. Since selling Barefoot Wine in 2005, Michael has become an avid angel and seed round investor. And in this episode, we dive deep into Michael's investment philosophies, strategies, and secrets. Michael kicks off the episode by giving us a very detailed overview of his cash flow first outlook. In this age of negative balance sheets and companies who never seem to make any money on paper but are still worth billions of dollars, Michael's outlook is a refreshing perspective. Later on in the episode, Michael details the stories and the lessons that he learned while building Barefoot Wine, and how all of these mistakes, no matter how painful they may have been in the moment, have ultimately made him a better investor and a better investment partner. And finally, we conclude the episode with Michael giving us a very detailed list and overview of the things that a company must have before he invests in them. Listen, I know that I say this from time to time, but this episode is an absolute masterclass. And whether you are building a business or you are a passive investor that's looking to invest into businesses via seed round investments, via venture capital, via angel investing, there really is a tremendous amount of knowledge shared by Michael on this episode, regardless of what side of the table you are sitting on. So without further ado, everyone, let's welcome to the show, Michael Houlihan.
The Gould Mine Podcast.
I'm super excited to chat with you. And are you an active investor in any venture capital funds right now, or?
Well, I have several investments, but they're not through venture capital funds. They're just private. You know, I'm what they call private money, you know? So, but I wind up being mentors and directors for the people I invest in. So I know enough about business and I know enough about building brands. I don't take anybody who isn't, building a brand to sell it. If their goal is not to sell it, I can't help them. Yeah. But if their purpose is to exit, then I can help them. Because that's my specialty. So I help them, but I also have to get other investors involved. And so I basically translate their engineering speak into plain English for investors to understand. And so many, especially of these young people today, they like to use that jargon. They like to drop terms. Yeah. But they confuse their investors. Well,
I mean, I think we just got to, I want to keep that little clip in there, Michael, because I think this is just a great way to kind of introduce the audience. Welcome to the Gold Mine, by the way. You bring a really fresh perspective, to all of this. And so I'm curious, you say that you're investing into these companies. They got to be positioning themselves for sale or have sale as the eventual goal that they wish to achieve. You're investing into these as like an angel investor then, I'm assuming, or some sort of like angel investment is kind of what I'm hearing, correct?
Yeah, it's a combination of angel investing. Yep. It's pre-A investing, so seed money investing. And then it's also mentoring. Yep. So many of these folks have great ideas, but they lack certain soft skills necessary to attract the kind of investment that they need. They have the customers.
Sure. It's interesting that we're chatting now 2025, because I think that we've, over the last 10 years or so, maybe even like the last 5, we've seen kind of like the rise and fall of venture capital, seed round funding, that sort of thing, right? Because when I was in school, I went to Stanford, right? So just up the street, right? And when I was in school, this was like the heyday of venture capital. Every single one of my classmates, right? I had people, my roommate at the time, my 2 roommates at the time, after we roomed together sophomore year, they took off junior year and tried to do their own startup, right? So everyone was going after VC money. And then it seems like over like the last 5 years or so, there have been fewer and fewer success stories and more money being pumped into the system. So cause and effect there, right? Like, what are the patterns that you're seeing right now kind of in that world?
Well, I think the big thing is that investors have gotten burned. And when you talked about 5 years ago, they were focusing on things. They were focusing on products, or they were focusing on software when they really should have been focusing on the management culture of the company that they were funding, and how the company was organized, and whether or not the company understood how to deliver to the customer, timing, all that stuff, marketing. So unfortunately, many of the VCs are engineers themselves. So they struck it rich, man, and then they decided that they wanted to do the same thing.
Yeah,
but
pay it forward.
It's one thing to make money selling something that everybody wants. It's quite another to educate people about how something new is going to benefit them in their lives, or save them money, or, upset the system. So this is why communication is so important for investors to be looking at. And they've only recently realized that. And this is why you don't see the seed money investors like you used to. Now you see a lot of A and B investors because they want it further down the road.
Sure.
Because they don't want to take the risk that the company that they're investing in doesn't have the soft skills and the organizational skills to actually pull it off. Whereas in the old days, they were just interested in the engineering skills. And they thought the world was going to knock down windows and break down doors to get to their solution. With no idea of how they were going to actually deliver the message. See?
Yeah.
So, And I have had many people come to me looking for capital. And I say, well, what happened on your last business? Because I see that you guys went out of business. And they usually say something like, well, our second round of financing fell through. Yeah. And I just look at them and I say, no, I said, I think you didn't achieve positive cash flow because you didn't make sales faster than you were spending your investors' money. Isn't that why you went out of business? Well, yeah, I never thought of it that way. I guess you could look at it that way, they'd say. Yeah. So, I steer clear of those folks. I'm looking for folks who actually can communicate the benefit of what they're doing in the shortest number of words, the cleanest way, with the most impact. That's the first thing I try to determine before I even know what they're selling, because that's the door, right? They got to get through.
I mean, it's fascinating, and you have such a unique perspective, right? You launched Barefoot, you successfully sold the brand, and I don't care who you are, right? Like you could have literally never consumed a drop of alcohol in your life. Everyone has seen your bottles. I mean, they're hard to miss. So from a messaging perspective, from a marketing perspective, it's obvious to me that you know what you're talking about because you did it. And it's interesting that you say deliver the message, because I see this all the time, Michael, and I'm no business savant here, right? I'm just a regular old guy that invests into commercial real estate and hotels, right? But understanding that the message is the brunt of what you're focused on, right? Or that's really kind of like the way that you frame or approach your deal analysis makes sense to me, because when I look at like a lot of these startups, they're really smart people. They have great ideas, like you just said, right? They're super smart, but like I have no idea what problems they're solving for me. Like I get these guys pitching me all the time, and I'm like, I don't understand. Like I'm sure this is a great thing, but like I literally have no idea what you're trying to sell me.
Exactly. So this is why we've got to get back to basics. Bonnie and I have given lectures and courses in over 60 schools that teach entrepreneurship across the country. Mm-hmm. And this whole thing about trying to teach entrepreneurship has blown up like in the last 10 years. If you went back to 2001, for instance, there was very few schools. There was a couple of them. But what's interesting about it is the people who control those schools and who created those schools within the school of entrepreneurship, they were trying to decide what the emphasis should be, or out of what existing department entrepreneurship as a thing should come from. And one of the things they thought was, well, we're a school of technology, and we're going to create all these people who have all these great ideas to revolutionize the world. So really, they're not going to be able to sell their products unless we have a school of entrepreneurship. And then they bring into the school to teach people who are from the business department. So now you have tech and business, and they call that entrepreneurship, but that's not entrepreneurship. So then we taught at a school that is Bradley University, which is pretty interesting. It's in a place, Peoria, Illinois. And, it is quite the place. There's a tractor factory there, but what's there is Bradley University. It was founded by a woman whose husband was a watchmaker, and she and her successors developed a school of entrepreneurship. And that school came right out of the liberal arts department. So it was really the first entrepreneurial school that I know of in the country that got it and said, if we can't communicate it, if we can't sell it, we shouldn't make it. See, and it doesn't matter if you know all about how to read a set of books. That's the business school. Yes, you need to know that, but that's not what's going to do it. Because if you're not making the sales, you're not going to have the money to pay the guy that does the books. See, if you don't make the sale, you're not going to have the money to pay the engineers to make the products. So getting your priorities in order is what I appreciated about Bradley University. And so, and like I say, we spoke at 60 of them. And we spoke in Ireland at the International Conference for Entrepreneurship. And it was interesting because there was teachers of entrepreneurship from all over the world there. And they all came from different schools. And they all had different ideas about how to get people to attend their school, because their business model is to sell butts in the seats, right? Sell people who are buying education. So they would say, hey, come to our school because we have launched the largest number of businesses. Another one would say, oh, come to our school because one of our grads became a unicorn, and you know his name, right? He's the guy that did Nike, or you name it. See, so that's the hero idea. And then another one would say, oh, no, come to our school because we raised more money for startups than any other school. And so we got up and we said, we think all three of those ideas are wrong. The only idea that would get me to go to your school is if you said, come to our school, 75% of our graduates are still in business 3 years later. In other words, they achieve positive cash flow. See, they're running, right? So I think that's a really interesting discussion, Danny, because you're getting right to the heart of what the investor really should be concerned about, which is what's going to happen to my money? Can I really go to sleep at night? Have I thought of all of the changes and challenges that this young company is going to face? So it gets down to the interview process, Well,
it's so funny. It's I do believe that tech in particular, right, these last 10 years has almost like perverted business fundamentals, right? Or the conception of like what business fundamentals should be, because yeah, you're right. Like revenue, like net operating income, EBITDA. Wouldn't it be nice if we had like like we were making money from day one? And it's interesting because in Silicon Valley, And it's so great having someone on here that like is in this area, understands this area, because like it just like some of these business, it literally makes no sense. It's like they're crushing it. Their stock price is like through the roof, but they haven't even achieved like even 1 year of positive cash flow.
No.
Doesn't make any sense.
See, and this is the thing, when you invest in real estate, you're asking yourself, well, where is it located? What do the rents look like? It's more basic because it's very close to you. But the minute that you start to invest in other areas, it starts to get very foggy. But Bonnie and I want to just bring it back to earth. We think it's fun to be excited. My mother, and I'm an old guy. My mother was in the 1920s. She was a little girl. And she said, Michael, when airplanes were first invented, they were lighting the wings on fire. They were flying them through barns, and people were walking on the wings. And nobody ever thought they'd use one to get to Chicago. In other words, when technology is new, it becomes entertainment. It takes a couple of generations before they say, oh, this is what we can really use it for, right?
Right.
So people, they've got, rose-colored glasses to VCs, and they're, oh yeah, this is the next big thing, right?
Yeah.
No, it might be the next big thing to entertain people, or maybe you're entertained by it. But we've got to see some positive cash flow. So, we've often thought about writing a book, Danny, called Positive Cash Flow, just to kind of underline that idea.
No, I mean, I love that. I think that's a great idea. And speaking of positive cash flow, I want to take it back a minute, right? And kind of go back to your grassroots experience with Barefoot. Walk me through the steps that you took to achieve positive cash flow, because, we talked about delivering the message, right? And I hear that. From my understanding, your primary objective from day one, before getting the messaging right, I could be wrong, but my understanding is before getting the messaging right, you were dead set on getting in on as many shelves as possible, right? So you prioritize cash flow from day one, even even before thinking about like what's the branding and what's the messaging and what's the marketing going to be like. Number one, am I correct in my understanding of that? And number two, what was it that kind of created that mindset, or what was it that like kind of inspired you to have that mindset from the get-go?
Well, I think your perception is correct, because as a shopper, you saw Barefoot get out there. But as a producer and as a marketeer, we made some really tragic mistakes. And they're mistakes that are commonly held misconceptions. So if you line up 100 people, 99 are going to answer incorrectly to certain questions that have to do with marketing. And, probably the biggest problem that faces most business and where it breaks down, it's called the last mile. It's called where the humans handle it. It's called where the rubber meets the road, right? This is where it breaks down. So you can do the best job you can virtually, but when you really start getting into it, that's when you realize, oh my God, is it that corny? Yes, it's not only that corny, it's that stupid. So yes, you have to get smart about stupid. And I would say, to answer the second part of your question, is once we got into it, we expanded fast, scale fast, fail fast. Well, we failed fast, all right. We learned a lot of terrible lessons. We actually thought that it was in the interest of the stores to get a fast-moving product like Barefoot out of their back room and put it on the shelf so the next customer could buy it. Wrong. Even though it was in their best interest, they were paying people by the hour. So people have no interest in seeing the company make more money. For them, it was, what do I have to do to get paid? So basically getting paid for attendance, not for production. or not for profit. See? So now those old ideas really come from like the 1920s and the 1930s, and they're still prevalent out there. But most of the big companies that we worked with, we had to do most of the merchandising for the big companies because the buyers were just sitting in front of a computer screen and they were saying, well, your product's not scanning, because all they could measure was whether or not it went across the scanner at the cash register. But they weren't measuring whether or not it was still in the back room, whether it was out on the shelf, or whether or not it had the wrong code on it, or whether it was still in their warehouse and never got delivered to the store, or whether the potato chips were in front of it, or that the competition took it out and plastered it all over the store. So they couldn't measure that, see? So they got, and this is the thing with technology. Technology has bent our minds around copying out and dumbing down to the things that it can measure, the things that it can do, and then saying, oh, that must be the whole world. See? Because we can measure that this is what we can measure. But there is so much more that we cannot measure unless we physically go there and see what's going on. So, I mean, I got a call one time from a distributor in Twin Cities, and he said, Michael, he says, your wine, Barefoot, it's not selling in MGM store number 372. And I said, you got to be kidding me. I said, that's right in the middle of St. Paul, right next to the university. We should be doing good there. He says, you can't expect to be selling everywhere. I said, okay. So I hung up. I got on the plane the next day. I went to St. Paul. I went to that store. When I got to the store, I walked in, and what did I see? I saw the Lay's potato chip display, which is big. It's about 3 feet wide and about 6 feet high. It was right in front of the Barefoot. See? So yes, it wasn't selling in that store because nobody could see it.
Okay.
So then I realized, my gosh, if I don't go to every store, or at least have a cop that works for me, go to every store and really check this out, where the rubber meets the road, the last mile, then we're going to have poor sales. So I had to pull in. I actually was in certain states that I couldn't manage. This is called growing too fast. See? Yeah. And I got back, and this is what I tell clients now. Start small. Make your mistakes in a small place. Don't sell further from your home than you can drive, fix it, and apologize in one day and get home for dinner. See? And then, after you've learned what is really required, not just online, but offline, to make it work, and you figured out what that's going to cost you, because it's expensive to do somebody else's job, believe me. And by the way, when you do their job, you have to thank them for it and recommend them to their boss. So, I mean, you have to cop an attitude, or else you're going to go crazy. If you don't look at it with some humor or sarcasm, at least, you're going to go nuts. So what we learned at Barefoot was that we actually did 2 starts. The first start we did the Silicon Valley way, scale fast, fail fast. The second thing we did was we started small, and we became a hot seller in a small area. And then we were able to take the hot seller moniker with us to other states. But we didn't do that until we had a cop in that state who was on our payroll. And his job was to check up on the people who were supposed to be doing their jobs. And of course they weren't, see? So do their job then, you see? So that's why when Barefoot got into a store, it stayed there. It didn't just flash up and then out. It stayed there, and it's there today. And when we sold the brand, we looked for an acquirer who was expert at merchandising, and that's why we sold it to E&J Gallo, and they did a fabulous job with it. There's no question. So, yeah, that's my story, and I'm sticking to it, Danny.
Yeah, I know. Well, it's a fascinating. I mean, you've got a fascinating, perspective here, Michael, and the idea of wine cops. It's so funny because, like, you're right. Like, these are things that the average, like I would never think like, oh, well, the kid that they just hired 3 days, that Lucky's just hired 3 days ago, right? Isn't going to put the wine on the shelf the correct way, or accidentally put something in front of it, or maybe just forget to put it on the shelf altogether. But, as the owner of the business, it's like if it doesn't even get out on the shelf, you don't even have a shot.
That's right. And the worst thing is if you were on the shelf and then you're in the back room and then you get discontinued for no sales. I mean, we had one guy, a clerk, and he was in a store that was right across the freeway from UC Davis. So we gave a course at UC Davis every year. And we told the students, oh, yeah, go check this out over there, at the Safeway store or whatever it was across the freeway. And they did. They came back and they said, it's not there. It's not there. I said, it's authorized. It's in the set. What do you mean it's not there? So I went over there after the course and I drove over there. Sure enough, it wasn't there. And so I started asking around. I started asking one of the clerks. I said, what's going on with the Barefoot? I said, I see you got a bunch of it in the back room, but you're out on the shelf and you've been out on the shelf for at least a week or two. Well, what's up with that? And he goes, he says, that stuff sells so fast. I have to go in the back room and get more of it out. And I have to do that more often than these other brands. And, it gets tiring after a while.
Oh, my.
This is a guy who gets paid, I don't know, $18 an hour or whatever, no matter how much the company makes. See? Now, if you talk to the managers, they'll say, oh, no, that doesn't happen. See, because it's their job if it happens. Because then their boss is going to say, oh, no, you can't have that. But their boss is going to say, oh, no, that doesn't happen. So that's why I say they're commonly held misconceptions. The misconception is that the system is going to move a product that is a hot mover, that is in demand. And it actually works against you, see, because now you're up against the whole logistics nightmare of who's in charge that day. Were they awake? Did they care? Did they have a fight with their girlfriend? What happens?
Yeah. Right. Yeah. I mean, you're really kind of at the mercy, right? If you don't have the proper systems in place, right? So it sounds to me like you through experience, through trial and error, you develop systems and processes to ensure that, that those sorts of things didn't happen, or if they did happen, they happened a lot less frequently. And when they did happen, they got addressed more quickly than they would have been. Yeah.
Absolutely. And, the thing is, when you're new, this stuff happens a lot.
Mm-hmm.
But, it takes a while before you become such a national brand and so powerful that people are going, well, I've got to replace the Barefoot, because they can't find it here. They'll go buy it in another store. And then I'll lose the customer. But somewhere between startup and that point requires a whole set of procedures. Like we would send our wine cops into a store and they had a checklist, check the back door, make sure that the scan is correct. Okay. See if there's any inventory. If the inventory is incorrect or correct, see, and fix that. Make sure that it is on the shelf. If it isn't, put it on the shelf. Make sure that the reorder scan code is on the slot under the brand. See, make sure the potato chips are not in the way. It goes on. But, every time we would find something new, we would say, put that on the list. Yeah. Have everybody in the country check for that.
Yeah. That's amazing.
Yeah.
That's amazing. I mean, there's just so many parallels, right? Because in real estate too, I mean, you're always met with new surprises. There's always, I mean, it's a never ending game of whack-a-mole, right? And so once you whack the mole one time, you're like, all right, well, let's just add it to the list, right? And make sure that it doesn't happen again. But inevitably, there's another mole that pops up, right? So it's
and I'm a big believer, Danny, in the fool me once, shame on me, shame on you, fool me twice, shame on me, which is basically, we call it making mistakes right. Okay, you make a mistake right. here's what right is. It's WRITE, not just RIGHT. Yes, you have to correct your mistake. You have to apologize. You have to reimburse. You have to repair. Okay, fine. Now, what did you learn by that? And so here, what we do is we would say, okay, there are probably 40 documents in a company. How many of those documents need to be changed, updated, or added to so this doesn't happen again? Maybe it's a job description. Maybe it's a checklist. Maybe it's an inspection, all of these different documents. And you've got to, when you see something, you've got to do that. Like, I'll give you an example. We did a 40-unit, I would say it was a renewal project. We bought a 40-unit building and we put it into condos and cleaned it all up and sold it. And in the process, we had to deal with the city. And the city would do things like give us a permit to do some work and then come out and wave a red flag and say you have to stop. And we'd say, why? And they say, well, when we gave you the permit, we didn't realize that there was a storm drain right under your garage, but now we do, and if you want more permits, you will stop building that garage and move it 15 feet to the left. See? So even though I was in it for $100,000, and it had workers there, I had things going on, I had to stop it. We had to redesign the garages and move the garages because the city gave us a permit when they really shouldn't have. But I have to eat the crow because I'm the developer. See, I'm the guy who wants more permits from them. So they've got you. And boy, I'm telling you, that project just killed us. It took twice as long, cost twice as much. So, if anybody wants to know anything about redevelopment projects, I could definitely give you a list of things to watch out for.
No, it's interesting how, regardless of your experience level, regardless of how many deals you've done, these are things that just naturally come up, which I think is one of the main benefits, right? To having someone like yourself who's been through a lot of things, right? And who's been through, successful exits, but a successful exit means lots of days and nights where you feel like everything's gonna come crashing down and like it's just never gonna work out, right? Like it's not like you just magically woke up one day and you were, millions of dollars richer because you sold Barefoot. Like, talk to me about some of the struggles, right? Like, kind of getting through that, and were there times where you like legitimately thought this business is done for? Like, there's no way we're gonna make it.
Well, it's gets back to the commonly held misconceptions, and I guess I'm just too gullible, but I'm one of those people who got into it thinking, if I can make a big enough name for myself, Mr. Big's going to come knocking at my door. See, and a lot of people think that, okay, but the fact is, you got to get your peanut in front of that elephant. So basically, you choose your acquirer, see, and then you figure out what strategies you have to do, what changes you might have to make in your distribution or your marketing or whatever so that Mr. Big notices you, see? So that's number one. The other thing, too, is every minute that takes place during an acquisition works in favor of the buyer and against the seller. And here's why. Because the word gets out that you're for sale. You lose your top salesperson right away, okay? You might lose your engineers, okay? Another thing that can happen is the word gets out and your number one customer says, I understand you're for sale, Michael. We're going to wait and see what the next buyer is going to do in terms of pricing, in terms of quality, in terms of guarantee, and all of this customer service. See, so now, because the word got out, you have less to sell because what you're really selling, is your stock and trade, also known as goodwill, also known as your accounts receivable. See, that's what you're really selling. Yeah, you could have some property that you're selling with it or some machinery or whatever, But that's not why the guy buys it. He buys it because he wants to bolt it on to his existing system. He wants to make it part of his family. So that's another little piece of advice. And then the third, and so the way that you shorten the time between the time that Mr. Big becomes interested and you close with Mr. Big, that was to be the narrowest amount of time possible, is that you do Mr. Big's due diligence for him from day one. You organize your books, you organize your accounts to be the way that an acquirer would want to look at your business. Like, for instance, he's going to say, show me a chart that shows your sales year on year since you were starting. So I want to see, how you grew, right? In a chart. So you better have that. How about this? Show me every contract that you ever signed with anybody. Our lawyers are worried that we're going to get sued by somebody that you promised something to and didn't deliver because they see a dollar sign on our back. See? Or how about this one? Do you have a sign-off sheet for your logo from your artist? What do you mean? I paid her. She got $120 an hour. She's done. She delivered it. No. We need a legal sign-off sheet that says she can't come back and claim that she had certain interest in the artwork. See? So, these are the kinds of things that you really want to be savvy about. And I could list 100 of them. It's quite an education, quite an eye-opener for us. It was painful, Sure. A lot of this stuff you hear me spouting off about, we did the wrong way. That's why we know what the right way is.
Yeah.
It's funny how that goes, huh, Danny?
That's really the only way. There's only two ways to learn. It's from your own mistakes or from other people's mistakes. And normally, even if you've heard of other people's mistakes, you will still make the same mistake.
Especially if you're stubborn.
Especially if you're stubborn. Which I would imagine that, majority of successful business owners, founders, have a certain level of stubbornness, right? Because with stubbornness comes resilience, right? Those typically are coupled, right? So you have to have a little bit of that in order to be, successful. At least I think. You might think differently, but I
agree with you. I think you have to have a certain amount of, you have to have a high level of self-respect. You have to believe in your product. You have to hang in there and have tenacity to put up with the headwinds and everything else, and the phaser fire, all the stuff that you're going to get. But you got to be careful that you don't believe in it beyond the realities that you are up against. So you have to be humble. So you can be proud, but humble. And that's why I say, the minute you make a mistake, get out your keyboard, get out your pen, write it down. I made this mistake because I assumed this to be true, and this was what was true, and so assumed this, and so didn't get the memo, whatever. And then you examine what you've written down, and you say, how can I change this? How can I make this never happen again? And the answer is in your documents. So you say, okay, what are the documents that we use in this company when we hire somebody? Do we make them read a policy or a procedure, or do we give them a checklist or a sign-off sheet? Which documents need to be changed, updated, improved, you name it. And then when you do, you get everybody in your staff to sign off. Yes, I read this. I see how this mistake happened. This is not, in other words, make a big deal out of it. Really make a big deal out of every mistake, really big, and make sure that everybody that works for you understands how you made the mistake. When we started our business, our bottling contracts were only 3 pages long. When we sold our business, they were 37 pages long. That's how many times people got over on us.
Yeah.
And you see these contracts and they're so long, how did they ever get this long? It's because people are always looking for ways to, find a loophole, get what is the shortcut? How do I hack this system? And so you get hacked enough and you go, okay, this is what we got to do. So yeah.
Oh, man.
I have a lot of respect for people who have started with nothing and built businesses up and learned lessons. And maybe, it's taken them 5 or 10 years to get their business off the ground. But by that time, they got 5 or 10 years experience. So you don't go for national, you go for regional. Be a regional power first. And then when you've got your act together, then take your show on the road. Because if you take your show on the road before your act's together, fixing those mistakes is national. And your reputation is national. So you can build a reputation up for 10 years and you can lose it in 2 weeks. So that's why it's so important to take this stuff seriously.
So, question for you on that, right? Because now, with the internet, with the click of a button, you can be anywhere, right? You could you could sell your product, service, whatever, in anywhere in the world. So, for those that are trying to scale an online business, what is the online business equivalent of what you just said?
Well, let's take a big company like Amazon that has a virtual monopoly on merchandise these days. Okay, and also let's take a look at natural human laziness. Okay, so if you wanted to buy, say, an audio book, your first question might be, well, I have an iPhone and all my audiobooks are on iTunes. Is it on iTunes? Unspoken but implied, or I won't buy it. See, because I don't want to have 2 platforms on my phone, right? Mm-hmm. So now let's take a look at people who've been buying from Amazon. They want to buy everything they have on Amazon, and God bless, Amazon for being able to get into that position. They started as a very humble bookstore,
right?
If you know about the history of Amazon. But now let's say you're trying to sell your product online and you're on Amazon. You're also on other platforms. You might be on Alibaba or whatever. Okay. What happens when all of a sudden one of the lower level people at Amazon thinks that you're doing something with your product that is contrary to their policies and procedures? Boom, it's taken off Amazon. You start losing sales that day. Then you lose sales every day until you fix it. Now let's talk about fixing it, shall we? Okay. You might as well move in because it's going to be a career to fix it. So now you have to remember the people who kicked you off, they want to justify their move. So if they can't get you off of there for what they found, they'll look for something else that you're doing that they don't like to justify having kicked you off.
Right.
So this is something you don't expect to happen when you're selling businesses, when you're selling products online. You do not expect to be at the mercy of these retailers. See? So the parallel is that, I had to deal with real retailers, like in the Midwest, some of the largest stores in America and box stores, big box stores. And they had policies. Like, for instance, at Costco, we couldn't sell Barefoot at Costco. We had to take Barefoot and send it to a repacker who packed it at our expense the way that Costco wanted to sell it. So they had their own design for cardboard boxes that our bottles would fit in. And they had their own idea that the bottles had to be printed. The bottom of the bottle had to be printed on a half of the box, so you could look through a case 3D and see what was in it. And then they wanted certain kinds of codes and descriptions and they wanted it on 4 sides of a pallet, and they wanted it shrink wrapped. So we would send it to the repacker. They'd do everything I said and a whole bunch more, and then they'd take it over. So when you're doing online these days, you're dealing with the requirements of the online marketer. Yes, you could probably sell direct from your home. A lot of people do that. But now you're just selling in onesies and twosies. You're not really selling any large blocks. And it's going to be hard to find an acquirer because you have to have one hell of an online business before you can sell. And then what that guy's going to do is he's going to put it in retail right away. So it's difficult. It's easy to get into online selling. It is easier than offline selling, but it is more difficult to build a brand online. It is more difficult to get paid for the value of that brand if it is strictly online. So most people who are online because they cannot get into retail. See? So it's not a choice so much as it's a fallback. But yeah, it's a challenge all the way around. I mean, there's no easy businesses out there. I'm sorry.
No, I mean, that is so true. And honestly, I mean, I never really even thought about what you just said. I mean, the activation energy is a lot harder for retail. But what you're saying is that once you can get into retail, if you have the proper procedures in place, if you have the right branding, the right messaging, all those things, then moving the needle and then achieving positive cash flow is going to be easier, in your opinion. Like that's kind of what you're saying.
Yeah. It does get easier. But there's a lot of surprises. The amount of money you make per unit drops significantly. You can expand 100%, but you're not going to make 100% more net profit. You're going to make 50% more net profit because now that you've expanded, the other 50% is paying for the cops so that you can have that other 100% in the first place. That's interesting. Yeah. And then it gets smaller as you expand out.
Yeah. That's, I mean, I feel like that's the case with any business, right? It's like you start off, your margins are pretty good, right? And then you figure out, well, there's only one of me and there's way more things to do. And now I've got to hire more. And so then you keep going, then, it's just this like slowly eroding margin line, right? As you add more and more people, and even though sales are increasing, your margins decrease. So speaking of margins, speaking of cash flow and kind of putting a bow on this overarching theme, which is when you're assessing a business, Michael, that you want to invest into, aside from positive cash flow, what are 2 to 3 other indicators or traits, characteristics that you look for in a business that you're going to invest into?
Well, I think that, obviously the saleability and, their ability to accept the merchandising responsibility and not argue about that. Oh, the distributor's going to do it. Oh, the store's going to do it or whatever. But to actually say, no, this is going to be my responsibility. Aside from that, the next thing I look for is what kind of a millstone do they have around their neck? And what I mean by that is what kind of monthly bills do they have to pay, whether or not they're making sales? Yeah. Because what happens in life is you have good streaks and bad streaks. How would you like to have a bad streak and still have to pay a bunch of money out? So I look for people who are smart about this. A lot of people, they go into business, they say, I'm going into business, I need a warehouse, I'm going to need trucks, I'm going to need this and that. And then there's always some guy that will finance them because he says, these are real things. I'm buying real things, so he feels comfortable. So now this guy's got all this overhead, right? Well, the trucks need maintenance, right? And their tires are going to wear out. They got to be handled and all that. And, the warehouse, it's going to wear out. And there's going to be problems with the warehouse. It needs insurance. It needs security. It needs electricity. It needs all this stuff. So what I look for businesses that are smart enough to farm out or to outsource, whatever term you like to use, most of the work. See, so Barefoot wasn't a success because we had a big winery and lots of vineyards. It was a success for the opposite reason. We put our money into marketing and merchandising because we knew that was the problem. As far as production is concerned, you could always get somebody else to produce your product for you on contract. And the advantage of that is that when you write the contract with this producer, you say, in effect, in street language, I will not pay you unless it's exactly the way that I'm saying in this contract. It has to have this oxygen level. It has to be this temperature. It has to be in this bottle. It has to. All the has-tos, or else you don't get paid. Now, you can't do that with your own people because you're investing in all that hardware and all those people and all those hours. So you're likely to want to put an imperfect product on the market just to maintain your cash flow. So you could actually have better control over cash flow. A better control over quality control if you outsource and you contract it properly. So that's one thing I look for. And the other thing is I also look for what it is that they're not outsourcing. And here's what I want to see. I want to see that they're not outsourcing sales. They're doing that themselves. They are not outsourcing accounting. They're doing that themselves. And they are not outsourcing quality control. They're doing that themselves. So even though they contract with another person to do the job for them, they have their cop on the line when that other company is running their job. See, it's important. So basically, Barefoot was like a police department. It was a bunch of cops, and each one of them had a job to do, and they had to deal with the outsourced people that were producing. Why do I say that? It's because I don't want to invest in a company where I get sucked in to, our sales are down and we still have to make this mortgage payment, or our sales are down and we still have to pay for this piece of equipment we bought, or maintenance, or you name it. So, and then the last thing I look for is how they're deployed, how they're using their people. I want to see that they've got at least one salesperson for every one person who's in the office, at least. I would really like to see 2 salespeople for one person in the office. And the last thing that I want to see is how are they paying their people? How are they paying people do what they're paid to do. Remember, I told you the story about the clerk. He's getting paid $18 an hour, whether or not the Barefoot goes on the shelf. See? Yeah. So naturally, he doesn't want to do the thing that requires him the most work for his $18. See? So the same thing is true with your own people. How do you pay them? Do you just pay them for attendance, an hourly wage, or do you cut them in? And how often do you cut them in? Do you cut them in once a year with some kind of a profit sharing thing? Or do you get smart about it and cut them in every quarter because they can't remember a year? And if they have a good first 3 months, they might slack off for the rest of the year. See? Yep. So, you got to really get serious about compensation plans. And that's something that we became expert at because just like the 37-page contract, they got over on us every year. So we tightened it up until finally, it's like, this is the contract. You work for us. This is what you do. You get paid, and we're going to pay you a lot if you help us make more profits. And then I guess one more thing I look for is whether or not the company has graphically, and I mean graphically, I'm talking about a picture here, mapped out the entire cash flow. I want to see that dollar where it starts with a customer, where it goes through the first business, where it goes into the second business, where it goes into your business, where you pay all your bills, and where there's money left over to pay the employees. And I want every employee to see that map and sign off on it on the day they're hired, because I don't want anybody coming to me thinking I got a big rock candy mountain behind my house. I can just shovel gold into the trunk of their car because their wife had a new baby. See, that's not going to do it. I've actually got to see an increase in profits if I'm going to do that. So like I said, bring me a bone and I'll cut you a big piece, but please don't ask for a piece of my bone.
Yes. Well, there's actually a lot of wisdom in there, Michael. If I had a nickel for every time an employee asked me for a raise, I'd be rich beyond my wildest dreams. That's interesting. I mean, and there's so many different ways to create that buy-in too. Are you familiar with EOS by any chance? I don't know if you ever run it, but are you familiar with EOS?
Slightly, but
slightly.
Go ahead.
Yeah, no, I mean, a similar thing with the EOS model where, just being very transparent with the organization, mapping out the, kind of like the life of a dollar in the company, right? Kind of idea I think is really smart. Because a lot of employees, they just see the company making a lot of money, right? And they're like, well, you must be rich.
And Danny, they come from other companies.
Right.
So many of them are already brainwashed into this misconception.
Right.
Which is somehow it's the owners of the company who have the money. You know who has the money? Customers of the company. They have the money. So the question is, how does the customer's money get into your pocket? What is every, hurdle and hoop that it has to shoot through to get to you? And it not only gives them an appreciation for the entire system, but they see how their job fits in. Oh, I see. I take care of this aspect of this big machine out there. See? So they get the big picture. And what I found is that most of the companies that we look to invest in, the employees do not have the big picture at all. So you would either have to, acquire the company and then you'd have to train them, or you'd have to fire everybody and hire new people who got a different view of how money is made. But if you're picking up on a company that's you got more than 3 employees, if you're buying a company with more than 3 employees, that's when it becomes really critical, because the first 3 employees of the company, you don't have to tell them where the money comes from. They know, because if they don't make a sale tomorrow, they're out of a job. They're got it.
Yeah.
Once you get up to like 40, now it's like, oh, well, I'm a specialist. I'm an engineer. I had a guy come into my office. He was applying to be an engineer. And I said, I see that the last company that you worked for went bankrupt. He says, oh, that was the sales guy's fault. The sales guys let us down. I had nothing to do with sales. I'm an engineer. And I said, well, thanks for applying at Barefoot and good luck with your career. Because I couldn't hire that guy.
Of course.
Because he didn't think he had anything to do with sales. And there's nobody in any company who isn't involved with sales. You cannot get isolated, insulated, unless you want to know the sales report you get is a pink slip, right? There's your sales report. It's like, come on, guys.
Oh my God.
It's pretty crazy, Danny.
Michael, I could talk to you for hours, man. This has been a really quick hour. I'm looking at the time and I'm like, oh man, we're running up on time. I do have a couple last questions here for you before I let you go. First one, we touched at this at the beginning, and it's interesting how we kind of weaved it in and out. This idea, this concept of only working with or only investing into founders, companies that have acquisition, right? Selling the company as their end objective. And the question is, why? Like, why is that? Because I already know what your answer is, or I think I know what your answer is going to be. But for the audience, right, for them to truly understand, like, why you're holding on to that philosophy as an investor.
Okay, so here's the deal. The fish can swim upstream, but it can't really tread water because the flow is so great. You go right out to sea. So you hear some people say, oh yeah, I'm getting rich on my business. They're not, because they're not growing their business. If you're growing your business, you're constantly reinvesting in your business. So it behooves people who own businesses to put themselves on a budget. If they make an extra $100,000, a business owner, especially startup, a savvy one, he's not going to say, oh, I think I'll build a swimming pool. No, he's going to say, I think I'm going to put a sales representative in Arizona, and I need the $100,000 to prime the pump in Arizona, because we're going to have to take a lot of people to lunch. We're going to have to fly around a lot, stay in hotels. We're going to have to do a lot of kissing up. And I've got to pay this guy for his wife and his 2 kids, even though he's not breaking even for maybe 5 or 6 months. Well, that's $100,000 right there.
Yep.
So much for the swimming pool. So the idea is, when then do you get paid? And the answer is when you sell. So there's the reason. It's like you get paid when you sell it. And what I like to do is work with companies that I see the upside of the sale and share it, because that's where the real money is. The real money to be made in any business is on the acquisition, if done right, of course. And so since I've been through a couple of acquisitions, and like I said, good ones and bad ones, I've learned some lessons, and I can get in there and I can add value to that journey and help them cross the finish line and get that freaking gold medal that they deserve.
Yeah, I mean, that's awesome, man. And to be honest with you, I mean, as a business owner myself and having, run several businesses over the last decade or so, the critical mistake that I made with my first business actually was I didn't have an exit plan. Yeah. My exit plan was not, because that just wasn't like for me, it was it was almost like a passion project, right? And so if you don't have that exit, or you don't have that plan in mind ahead of time, I think you're set up for failure, truthfully.
All I'd add to that, Danny, is that, people ask me all the time, how do I set myself up, for success? Where success is being acquired and getting paid for my work and all my hard work and all my sacrifices. Okay. Sleepless nights. Okay. False starts, mistakes. How do I get paid for that? Here's what I tell them. Take a broker to lunch. Take a broker who is a business broker, who is in your vertical, who has been involved in the sales of businesses that are just like yours or close to yours or in your neighborhood or in your region that are about your size, and ask them these questions. Who sold that's just like me in the last 2 years? What did they sell for? How big were they? How many states were they at? How many employees did they have? What was their rate of growth year over year? What was their capitalization? What did they get paid for when they sold? It goes on and on. Okay, so now you get the answers. You write them all down. And guess what? That's your blueprint. You don't have the luxury of setting goals if you know that your business at your price point, addressing your market that is very particular, very narrow, okay? But that narrow column, right, that you're in, what it does is it only sells if there's 500,000 units a year being sold by you. Well, if you know that, you're gonna say, well, then I guess my goal is to get to 500,000 as fast as I can.
Right.
See?
Right.
So now, you're kind of like being dictated to about how you have to grow your business based upon how you get the peanut in front of the elephant, which is where we started this whole conversation. So you got to know what the elephant likes. What does the peanut look like, right? And is your peanut shaped the right way? Does it smell the right way? See? Yeah. So what is the right way? Okay, the broker knows. He's been through it before. And take this. Take the broker to lunch every year because things are always changing, right? Things are changing in the market. And, there's not one size fits all. So you'll get an update from the broker. And interestingly, the broker will pay for the hamburger.
It's funny how that works, right? So they're incentivized for you to make that happen, right? They want it to happen just as bad as you do. Michael, this has been just as good of a conversation as I thought it was going to be, and then some. So I really appreciate your time. Appreciate you stopping by. But you're not off the hook yet, okay? Because just like every other guest that's been on this show, before you leave, I want you to impart the audience with one final Gould nugget. Take it away.
Start small. Make your mistakes in a small place. Get your act together before you take it on the road. Don't scale fast to fail fast. In fact, don't fail. Scale slow and steady as you go.
Love that. Love it, Michael. Could not agree more. This has been awesome. Thanks so much for stopping by. And I hope it's not the last time you're on this show. I really hope that we can have a follow-up here. This has been a great episode, Michael. Appreciate your time.
Well, thank you, Danny. It's been a pleasure being with you.